The year is 1720. Isaac Newton, the man who discovered gravity, invented calculus, and explained how planets move, is sitting in his London home, staring at a piece of paper. He's just lost 20,000 pounds. That's roughly $4 million today, maybe more. The genius who could calculate the motion of every star in the sky couldn't predict what people would do next. And here's the wildest part. He saw it coming. He called it. He got out early with massive profits, and then he jumped right back in. What made him do it? And why does this 300-year-old mistake still matter today? Before we get to the crash, you need to understand something. Newton wasn't just smart. By 1720, he was rich. He was earning over 3,000 pounds per year, putting him in the top 1% of Britain, close to the top 0.1%. He had a horse-drawn carriage, servants, and a massive investment portfolio. But here's what's interesting. Newton never bought land, the traditional marker of wealth. Instead, he was one of the first people to put his money almost entirely into financial instruments, government bonds, and stocks in big companies like the Bank of England. He was a modern investor, careful, diversified, successful. Before the South Sea bubble, Newton's investments in the 1710s appeared to have been those of a careful and shrewd person, and were very successful. So when the South Sea Company started making noise in 1720, Newton was already a shareholder. He'd been invested for years, quietly making steady returns. Everything was going according to plan. Then the mania started, and it changed everything. The South Sea Company was founded in 1711 as a way to manage Britain's national debt. Sounds boring, right? But in 1720, something shifted. The British government announced that the company would take over most of the national debt. Suddenly, South Sea stock wasn't just an investment, it was a national project. Everyone wanted in. The stock started the year at 128 pounds. By April, it hit 320 pounds. By July, it peaked around 950 pounds. That's a 640% gain in 6 months. The streets of London were buzzing. Coffee houses were packed with people talking about their profits. Your neighbors were getting rich. Your friends were getting rich. And Newton, he was getting nervous. Sensing that the market was getting out of hand, Newton liquidated his stake at a large profit, pocketing a 100% profit totaling 7,000 pounds. He was out. Safe, smart. He'd beaten the market. But the stock kept going up. Imagine watching from the sidelines as everyone around you doubles, triples, quadruples their money. Your coachman is talking about his South Sea shares. The guy who sells you coffee is bragging about his returns. Newton jumped back in, almost at the peak. Not just a little bit, almost all his money. In June 1720, he reinvested 26,000 pounds at significantly inflated valuations, between 700 and 1,000 pounds per share. Here's where it gets crazy. Newton was putting his money into South Sea stock just about the time he was finishing liquidating most of his holdings earlier in the year. Now here's my question for you. Would you have gotten back in? Be honest. Drop a comment below, because I think most of us would have done the exact same thing. The hardest part of investing isn't buying low or selling high. It's sitting still while everyone else gets rich. September 1720, the bubble burst. The stock collapsed from a peak of 1,050 pounds in June to 124 pounds by year-end, erasing nearly 80% of its value. Fortunes vanished overnight. There was a marked increase in suicides and widespread anger and discontent in the streets of London. And Newton? His losses, even by conservative accounting, almost surely exceeded 10,000 pounds, and plausible methods easily produce values that exceed the 20,000 pound figure that family lore claimed.
To put that in perspective, by comparison with typical earnings and making allowances for a very different society and economy, £20,000 in 1720 might be comparable to £20 million, $20 million, or 20 million euros today. After it was all over, Newton supposedly said, "I could calculate the motions of the heavenly bodies, but not the madness of people." Here's what makes this story so important. This wasn't some random guy gambling his savings away. This was Isaac Newton, literally one of the smartest humans who ever lived. Newton died rich, with an estate valued at about £30,000, but that is primarily because he was already rich on the eve of the bubble. If he'd just stayed out, if he'd trusted his initial instincts, he'd been worth over £50,000. But here's the thing. Newton wasn't dumb. He was human. The South Sea Bubble teaches us 3 critical lessons. 1. Intelligence doesn't protect you from emotion. Newton could calculate planetary orbits, but he couldn't resist FOMO. 2. Getting out early doesn't mean you've won if you jump back in at the top. Newton correctly inferred shares were overvalued and sold them at a handsome profit, but eventually capitulated and bought back in as the bubble inflated. And 3. The South Sea Company artificially inflated its stock prices and colluded with several MPs in insider trading schemes. The game was rigged from the start. When everyone's telling you it's different this time, it probably isn't. And that brings us back to the question, why did Newton do it? Because he was watching everyone else get rich while he sat on the sidelines. The same reason people bought into the dot-com bubble. The same reason people mortgaged their homes for crypto in 2021. The madness of people hasn't changed in 300 years. The South Sea Bubble was the first major stock market crash in history, but it definitely wasn't the last. Have you ever gotten back into an investment after selling it, only to watch it crash? No judgment. We've all been there. The smartest investors aren't the ones who predict the market. They're the ones who control their minds. See you in the next one.